is running out for banks as the deadline for the LIBOR transition draws near. Banks are gearing up for the world's largest corporate action to safeguard their businesses and reputation. Though LIBOR-based rates support $200 trillion worth of financial products, it is set to go, and RFRs are the potential replacement. The regulators and central banks have reiterated their position and insist that banks support and demonstrate capability to RFRs ahead of the 2021 deadline. Fresh issuances post-2021 would be based on alternative reference rates and risk-free rates. Many regions are looking at multiple rate approach, with both LIBOR and RFR coexisting. But are the banks capable of handling RFRs as well? LIBOR transition impacts bonds, floating rate notes, loans, deposits, and derivative products in firms like banks, insurance, asset managers, corporations, and financial institutions. Intellect products including treasury, asset liability management, core banking, lending, wealth, trade finance, and others have capability to support RFR-linked products. Enabling RFR capability will allow financial institutions to capture wallet share as the industry transitions to RFR-based products. LIBOR is a benchmark rate that some of the world's leading banks charge to each other for unsecured loans of varying tenors. The LIBORs would get replaced by new risk-free rate or benchmarks like SOFR for US dollars, SONIA for Great British Pounds, and ESTR for Euros. However, RFR are quite different from LIBOR, and they cannot directly replace LIBOR. LIBOR includes a measure of bank credit risk, and as a term rate available over a range of maturities. It is calculated on a consistent basis across all 5 currencies. RFR are backward-looking overnight rates on a pool of virtually risk-free investments. They have differing characteristics that reflect their underlying local market. This puts tremendous pressure on daily interest accruals, payments, and settlement, valuation, pricing, and risk management. Let's look at some of the problems RFRs pose while adopting in the financial products. How to achieve clarity on averaged rates and interest payout date. Most RFRs are published on a next business day basis. For example, rate for a day is not available at end of the day. Markets must agree on a convention to consume rates on a lag basis, for example, from previous business days. Many market conventions, which includes averaging approaches, have evolved to overcome the limitation due to non-availability of daily rates. Look-back, lockout, payment delay are some popular conventions. How to get rates in compound the rate approach. ARR benchmarks are overnight rates, and daily compounding calculation methodology will modify the way interest is calculated. LIBOR for interest period are known beforehand. However, RFRs for the interest period need to be calculated based on daily compounding of rates based on OIS principle. What is the change in fair value of legacy contract on transition to RFRs? What is the correct fallback spread? The difference in the LIBOR and SOFR is due to difference in credit risk between the two rates. This has implications on calculation of fallback rate, which necessitates addition of spread adjustment to average ARR rate. How do I calculate the fair value of the RFR contract on an ongoing basis? Fair valuation of RFR contracts on an ongoing basis will require building of new RFR-linked forward and discount curves, which can be used for cash flow projections as well as discounting. Let's have a look at the system problems. In most banks, the core banking applications are customized to meet customers' expectations of tailored messages. For LIBOR mitigation, vendors suggest core banking upgrades. This becomes costly, time-consuming, and high risk. Why Intellect RFR Calcservice? Intellect RFR Calcservice minimizes changes to the product processors and speeds up compliance to the benchmark. And how does it solve customer problem? Intellect RFR Calcservice seamlessly operationalizes RFRs in financial products and renders fair valuation. Intellect Solution RFR Calcservice determines the complex calculated rate by using the averaging methods and incorporating the multiple conventions options. The system can calculate the appropriate rates for RFRs, SOFR, SONIA, etc., enable NCR calculations, select daily compounding or simple average, and select backward shift or other approaches. It also incorporates the daily floor adjustment. Intellect RFR Calcservice can also be used more broadly in RFR curve building, spread determination, economic value impact of migration, and interest validation. Credit spread. System calculates the credit spread adjustment for LIBOR versus RFR using ISDA's historical median approach. We see that the credit adjustment increases with tenor of LIBOR. Economic value. System considers the contract parameters and forecasts LIBOR and RFR cash flows of the original. For example, LIBOR and RFR-based contract structures. System calculates the NPV of the original contract, of the revised contract, and the notional gain or loss. It further recommends the CAS to minimize the difference in NPVs. Curve building. System maintains the forward and discount yield curve for various currencies, which are used for projections and discounting. Intellect RFR Calcservice is based on API design, which can be coupled with any systems. We have viewed the RFR Calc screen-based interface so far. However, on a day-to-day basis, the interaction between product processor and RFR Calc would be via REST API interface. This increases efficiency in integration. Request parameters are keyed in and sent to get response value from RFR Calc. Being an API-based component, the RFR Calcservice enables faster LIBOR to RFR mitigation without requiring extensive changes in testing of core and/or lending system. Intellect RFR Calcservice comes with loads of benefits. Speed of implementation. Minimize changes to the Intellect products or other bank applications. Provides averaged rates based several market conventions and averaging methods. Renders fair valuation. Impact on profit and loss because of migration, fixing the fallback spread, valuation of RFR trades and portfolio-based contracts. Pricing support and flexible risk projections using advanced curve builder. Talk to us about your challenges and let us help you with your transition strategy. Schedule a demo today.